You opened your 401k app this week, and the number is lower than last time. Maybe a few $100s lower, maybe a few thousand. Either way, your stomach dropped a little. You're not alone, and this video is going to tell you exactly how to think about it and what moves actually make sense right now. Let's start with some context. Right now in 2026, the market is navigating real uncertainty. The Middle East conflict has pushed energy prices higher. Inflation is still being watched closely, and investors are waiting on the Fed's next move. And if you're not sure who the Fed is, just think the bankers, the people who set interest rates and influence how much everything costs to borrow. That combination of factors creates exactly the kind of environment where dips happen and where emotional decisions get made. But here's what you need to understand about your 401k specifically. Your 401k is not a day trading account. It is a decades long savings vehicle designed to weather exactly this kind of volatility. The whole structure, diversified funds, automatic contributions, employer matching, is built to protect you from your own impulse to react. And here's something a lot of people forget. In most cases, outside of buying a first home, you cannot access your 401k without a penalty until retirement age. That's not a flaw in the system. That's the system working exactly as intended, keeping your future self protected from your current emotions. So, what are the actual mistakes casual investors make during a dip? Mistake number one, stopping contributions. When the market dips, the worst thing you can do is pause your 401k contributions. You're effectively choosing to buy fewer shares when they're on sale. Every dollar you put in during a dip buys more than it would have a month ago. Mistake number two, moving everything to cash or bonds. This feels safe, it feels responsible, but market timing is one of the most dangerous games in investing. Research from Hartford Funds shows that investors who missed just the 10 best trading days between 1996 and 2025 saw their total returns fall by about 56%. And those best days, they almost always happen right after the worst days. You can't have one without the other. Mistake number three, checking your balance every single day. I know it's tempting, but behavioral finance research shows that people feel the pain of a loss roughly twice as intensely as the joy of an equivalent gain. So every time you open that app on a red day, you're basically choosing to feel awful on a day that is actually the best time to be buying. You're torturing yourself for no reason. Close the app. So, what should you actually do? First, check your asset allocation. If you're in your 30s or 40s, you should have a significant portion in equities. A simple guideline, subtract your age from 120, and that's roughly the percentage you should have in stocks. The rest goes into bonds and safer assets. A dip is a great moment to review that mix, not to change it out of fear, but to confirm it still reflects your actual timeline and goals. Second, consider increasing your contributions if you can. Dollar cost averaging, putting in consistent amounts on a regular schedule, is one of the most proven strategies in long term investing. A market dip is exactly where that strategy earns its keep. Third, remember that your 401k balance today is not your retirement. And while we're here, let's talk about something most people overlook. Your 401k is one of the most powerful tools you have. It reduces your taxable income at the end of the year, meaning on paper you might look like you're earning less, but you've got a healthy balance building quietly in the background. More importantly, it is the only legal way to pay yourself first, before the bills, before expenses, and yes, before Uncle Sam gets his cut. What matters is the balance in 20 or 30 years, and at that horizon, this dip will barely register on the chart. The best investor mindset during a dip? Boring, consistent, unbothered. Keep contributing, Don't touch the allocation, close the app. That's the whole strategy. Seriously, if your 401k is making you anxious right now, that's actually useful information. It might mean your allocation is more aggressive than your comfort level can actually handle. Talk to your plan administrator or a fee only financial advisor about adjusting it for your real risk tolerance, not your theoretical one. If you made it this far, I genuinely appreciate you. Please hit like and subscribe. It makes a world of difference for this channel and helps me keep making content that actually helps you navigate the markets. Thank you for watching. Or